Hello trader, is this look familiar? Most of the times, when you open a buy trade, set your stop loss and take profit targets, then after some time, the price starts to go down, hit the stop loss and then starts to move up towards your initial trade direction that could have made you profit instead of taking the loss due to immature stop loss hit. The same goes for the sell trade entries. After you short sell and place a stop loss and take profit target, the price starts to climb up to hunt down your stop loss, and only after then the price continues moving down to the original trade direction from which you could have won the trade and money, rather causing to take the unfortunate loss. In both the cases, leaving you with anger and frustration for losing the trades. So what's wrong is going here? What do you need to do to avoid suffering these unwanted stop losses most of the times? Should you not set a stop loss at all and keep losing trades until your balance dries out? Or is there any other best ways to minimize the chances of losing a trade over unfortunate stop loss hit that could be turned into a profitable trade otherwise? Well, let's find out. Hello everyone, my name is Syed Rahman and I welcome you in this video today, where I will show you some super important tips and strategies to set your stop loss levels in a way that will help you to protect your stop loss from getting triggered immaturely, save the trade, and minimize the number of your losing trades while maximizing the profits. This is one of the mostly asked questions and the cause of frustration by new traders, since not having enough experience on proper stop loss setup is one of the key reasons most of the traders fail to make consistent profit. So in this video today, I will show you 3 very simple but effective stop loss strategies, each of which you can implement in your trading, and at the end, you will learn how you can combine all these 3 strategies at once to set an impeccable stop loss each time you enter a trade. So just bear with me until the end and I will show you with graphical and mini real chart examples of what are the best places and positions you should keep in mind when taking a trade entry and placing the stop loss in the best possible ways to make your trades even more safe and be a consistent profitable trader by minimizing the number of your losing trades. So without further ado, let's get started. So first things first, to make your stop losses effective, you need to ensure 2 very important things, which are: you need to make sure that you have entered the trade at the right direction and position of the market. Before showing you the strategies to set the stop loss, let me first talk to you about the simple yet very powerful trade entry criteria first. Because no matter what stop loss strategy you use, if your trade entry is wrong, then you will suffer continuous losses in the long run. Which is why we need to clear a few things first. So first of all, make sure your trade is aligned with the general trend of the market. That means when you open a buy trade, do it when the market is trending up and not trending down. On the same way, consider opening sell or short trade entries when the market is in downtrend momentum. Remember that sell trade entries sees more successful win rate when the market is trending down, and worst win rate on selling is when the market is trending up. On the same way, uptrend markets are the best places to make buy trade entries, as buying win ratios are high in uptrend market, while a downtrend market is the worst place to make buy trades, as the downtrend is best to make sell trade entries. Also, you will need to avoid entering in a trade when the market is not trending up or down and only is in a sideways momentum. Sideways are the worst places to enter a trade unless the range is broken. So these are the most important criteria to follow the trend when you consider opening a trade. So always trade towards the trend and not against the trend, and no trades in a sideways market. This will decrease the number of your stop loss hit and therefore increase your chances of winning more trades. Now the second rule is, always respect the key market structures. Always look out and respect the support, resistance, and other price patterns when you open a trade. For example, If you see that the price has already moved down for a good distance, that it can become a support now, or the price is already near a previous support zone, then do not open a short sell order here, because the support levels are the areas where you should look for buy trade opportunities, unless the support is clearly broken by a breakout candle. So you should wait for a strong bullish reversal candle at a support to make buy trade orders. This will reduce your chances of losing a trade, hence help you to avoid getting your stop loss hit. On the same way, when price already moves up for a great distance and seems like about to make a new resistance, or the price is at the previous resistance level, then do not make buy trade orders. Rather, wait for sell trade opportunities here, since resistance levels are the great areas to look for short sell entries. I know that this seems very simple, but trust me, it is really tempting to make the mistake of opening buy trade entries when the price is already too high and make sell trade orders when the price is already gone too down. Most of the failed trades are caused by this reason alone, when traders open buy or long orders when the price is too high or at a resistance, and open sell orders when the price is too low or at the support level. If you don't follow this rule, then no stop loss strategy or no amount of stop loss can save your balance. So these are the two very powerful criteria to follow to make profitable trade entries. These two simple rules will allow you to open a trade at the general trend of the market along with the market key structures and strong entry signal to give you the confirmation to go for the trade. And that's very important, because without making the right trade entries at the right direction and position of the market, you cannot make consistent winning trades, as you will suffer from getting your stop losses being filled out if you keep trading at the wrong side of the market. Now that you know the key important things to consider when making trade entries at the right direction and position of the market, let's move to know what are the best places to set the stop loss in case of price starts to move against our trade direction, because no matter where you trade or how good you think the trade is, the market is always right and can move in any ways by making our trades end up hitting the stop loss. So over the years, I have tested many stop loss strategies, including various indicators like the moving averages, ATR or average true range, Bollinger Bands and other stuffs like that, but I have found that only 3 things work great in terms of practicality and effectiveness on setting the stop loss, which are based on pure price action that can be followed very easily. And I'm going to show you these strategies in a minute in more details. But before we start, if you are wondering about these small blue and red arrows at below and above the candles in my chart, then these are actually painted by an automatic trade alert indicator named Revkin Trend Entry Indicator, which does all the price and chart analysis and sends me automatic trade alert whenever there is any change of considerable market momentum at the up or downward direction in the chart. So whenever this indicator finds a potential trade entry, it sends me the notification, which I can receive in my phone and the PC. I then come to see the chart and make a decision about the trade alert, and if everything looks fine to me, then I consider opening the trades recommended by the indicator. This indicator makes my trading easier, since I don't always have to be around the computer to do all the chart analysis manually and look out for trade entry setups. This indicator does most of these things for me, while I only decide which trade alert to follow according to my trading experience. I will put a link of this indicator in the description, and at the first comment below, you can learn more about this indicator from there. Now let's begin to know what are the stop loss strategies that can reduce your stop loss hit and maximize your profit. So we will be discussing 3 types of stop loss strategies which you can use as individual stop loss setup or combine these strategies to make the stop loss even more effective. So for the first type of stop loss strategy, we will be focusing on the high or low of the most recently closed candle. Here, the closed candle's low or high will act as the support and resistance for the trade. This strategy alone is a good stop loss setup mostly for scalping and when trailing the stop loss. So for buy trade, set the stop loss at a few pips or points below the low of the recently closed bullish candle, as the low of the closed bullish candle will act as the support. And for a sell trade, the stop loss will go at a few pips or points high of the recently closed bearish candle. Here, the high of the candle will act as the resistance for the trade. Now, let's have some real chart examples of this strategy. So, in this strategy, if you make a buy trade entry when you find a strong candlestick pattern at the direction of the trend, which is an uptrend, and the key market structure also supports the trade, then place your stop loss at a few pips or points below the low of the last closed candle. By following this method, you can trail your stop loss in profit by placing the stop loss at the low of every next closed candle to aim for maximum profit you can get from the impulse move. On the same way, if you make a short sell entry at the direction of the trend and by respecting the key market structures, then set the stop loss at a few pips or points above the high of the most recent closed candle. This type of stop loss works great when the trend or market momentum is very strong and also very useful when trailing the stop loss in profit. Which means, if your trade starts to run in profit, then after every candle close, move your stop loss at the high of the previous candle after the closing of each candle at profit. This way, at the initial level, chances are less that your stop loss will get triggered, as the high of the candle will act as resistance, and even if the stop loss gets hit, it usually is not that big. And also, you can trail your profit safely as long as the market momentum is strong in your trading direction. And remember that don't place your stop loss at the low or high of a running candle. Always use the previous closed candle to set the stop loss. And don't just place the stop loss exactly at the high or low of the previous candle. Rather, increase the stop loss a little farther than that. This will allow your stop loss to have some room and avoid getting triggered in case of the price retests the high or low of the previous candle. In the third or last strategy, I will show you how many pips or points below the bullish candle and above the bearish candle is an ideal and effective place to set the stop loss. For now, just remember that you need to extend the stop loss further than the low or high of the last closed candle to make your trade safer. Now, for the second type of stop loss strategy, we will be focusing on the swing low or support and swing high or resistance levels to set our stop loss. In this strategy, for a buy trade, set the stop loss at a few pips below the low of the nearest swing low point or the near support level depending on the price action setup. And for the sell trade, set the stop loss at a few pips or points above the high of the nearest swing high point or resistance level in the chart. This type of stop loss setup is much stronger than the previous type of stop loss. Now, before moving to show you some real chart examples, know that I have prepared a PDF of all the graphics in this video, which you can download from my website. I will put a link in the description or in the first comment. So make sure you download the PDF for future trade reference and get better understanding of the strategies. Now let's have some real chart examples of how you should use this stop loss method. So if you're at the higher low or swing low point in an uptrend market and you take the trade at the direction of the trend after a strong bullish candle, then look out for the lowest price level of that swing low point and set the stop loss at few pips or points below the lowest price of that higher low or swing low point. Now here is the thing, if you are at the very beginning stage of the impulse move and the higher low of the uptrend is very near to the trade entry point, then there is a risk that the price may retest the swing low level before it continues to going up. In that situation, you can look for the previous higher low level or support level to set your stop loss for better safety of your trade. But of course, you also need to be careful about the size of the stop loss, which means if the support or previous swing low point is so far that the stop loss size becomes bigger than the targeted profit size, then reduce the stop loss size by placing the stop loss at below the low of a minor support level. A minor support could be the lowest point of a big or medium-sized candle since the high and low of these types of candles can act as minor support and resistance levels. If you traded right, then hopefully you will see price moving up at your targeted profit direction without hitting the stop loss. Now let's have another example of this stop loss strategy, but this time for a short sell entry. Here, if you make a short sell entry at the beginning of this impulse move at the downward direction, then placing a stop loss at the top of the bearish candle might not be a good idea, since it is very early stage of the impulse move, and there are chances for these types of patterns that the price may retest the high of the candle and trigger the stop loss. So at least place the stop loss at a few pips above the high of the swing high point, or to make the trade even more safe, place the stop loss at a few pips above the intermediate resistance here, which was a previous price rejection zone. This way, the stop loss is not very huge and there is decent amount of space for the trade to breathe. Now in the next candle, you can see that the price retested the high of the bearish candle, almost touched the stop loss level at the swing high, and then resumed the downward momentum of the market without causing any damage to the trade. So for short sell entries, if you catch the very early stage of the impulse move at the direction of the trend, then set your stop loss not at the high of the trading candle, rather at a few pips or point the high of the swing high, or at the near resistance level to make your trade even safer. But do not use this strategy on a sideway or ranging market. There, price tend to touch the highs and lows of the range very frequently. This type of stop loss setup is very powerful when the overall trend is very strong and can protect your trades even from sudden price movements. This stop loss strategy is not ideal for scalping. Usually, swing traders and position traders use these type of stop losses, as you can leave your trades for much longer period of time. Now let's move into our third and final types of strategy to set effective stop loss, which is a very important and the interesting one. This time, we will be looking to set the stop loss at the nearest psychological pricing levels, which are based on the rounded figures. The rounded figures are the whole numbers like 10, 30, 50, 60, 100, etc. These numbers play a very crucial role in trading, whether in Forex, stocks, commodities, or any other trading markets. So most of the times, you will notice that the price tends to reverse or bounce back from the rounded price levels of 50 and 100 like 1.1050, 1.1100, 1.1150, and also at the other rounded numbers in between these figures. The 50 and 100 round figure price levels are the strongest, while the other in between rounded figures like 20, 40 or 90, these levels also play a very important role in psychological pricing. This is because most of the times traders see these rounded price numbers as their trade entry and exit zones, which is why the demand and supply forces are very strong in these price levels, and that's why you will see most of the support and resistance levels to form in these types of psychological price areas. So these rounded whole numbers are some really important price levels to consider, not only to set the stop loss, but also to set your take profit target. Now let's understand this concept with some real chart examples. So as you can see, this is a plain 15-minute chart of GBP/JPY. The chart has both downtrend and uptrend with swing low or support levels and swing high or resistance levels, which are the areas from where price bounced back and changed the market momentum. Now at the visible part on this chart, if I draw horizontal lines at all the rounded levels of 100 like 165.00 to 170.00, the numbers which you can see at the right side of the lines, then you will notice that most of the support and resistance levels or the price rejection has occurred at these rounded price figures. Isn't it surprising? To add into that, if I draw horizontal lines at all the rounded number of 50, which are the 165.50 to 169.50, then you will come to see that the rest of the swing points or price rejection areas which did not occur in the 100 rounded numbers has indeed occurred in these 50 rounded numbers. And if I put all the horizontal lines at 50 and 100 rounded figures at the same time, then you will be astonished to see that almost all the noticeable swing points or support and resistance levels, which are basically the price rejection zones, has occurred in these rounded price levels. This is not a coincidence nor a fluke. This happens all the times in all the charts. Traders respect these rounded price figures. People buy and sell when price reaches to these areas, as these levels have psychological impact on all the traders all over the world, which is why it's important and we really need to consider these psychological price levels when setting our profit target as well as setting the stop loss. So, how do we set our stop losses based on these rounded price numbers? Let's talk about that now. To use the rounded numbers or psychological price levels as stop loss, we will need to combine the rounded figures with the previous two stop loss strategies we just discussed. So for a buy trade entry, look out for the nearest strong round figure below the lowest price of the last closed candle to set the stop loss, or at the nearest strong rounded figure below the swing low or support level. On the same way, for a short sell entry, look out to set the stop loss at a near strong rounded number above the recently closed candle or at a strong rounded figure above the high of the swing high or resistance level. You don't have to set the stop loss exactly at the strong round number like 50 or 100. It's better to extend the stop loss 10 pips more, since price may retest the 50 or 100 round figures. This way the stop loss will be even stronger. This stop loss strategy is extremely powerful since we are not only using the high and low of the candles and swing points, we are also considering the psychological price zones to set the stop loss so that our trades touch the take profit target and not the stop loss. Now let's have some real chart examples of this strategy. So let's say you have made a buy trade entry at the closing of this big bullish candle after this candle broke the sideways range. Now the lowest price of this breakout candle is 1.5305, so the nearest rounded figure is 1.5300. But since the lowest price of this swing point or the sideways is 1.5290, we will set our stop loss at this rounded price level. Please note that many times price crosses the 100 rounded figure and moves a few 10 to 20 pips more before bouncing back to the direction of the original trend. So extending the stop loss for a 10 more pips is a good idea for this trade setup. Now after this, for the next few candles, price moved up without hitting the stop loss and then created another higher low level. And let's say we entered for another trade here at the closing of this bullish candle. Although this is not very ideal trade setup, still let's say this is our trade. Now the lowest price of this swing low point is 1.5419. So for this trade, we could set the stop loss at the nearest round figure below the swing low point, which could be 1.5410, or to be even more safe, the price of 1.5400, which is the 100 rounded figure. Now, if we wait for the next few candles to form, then you can see that the next few candles have also moved up and then created another higher low level, and let's say we triggered another buy trade entry at the closing of this big bullish candle. Now this time, the lowest price of this swing low point is 1.5452, which is near the 1.5450 or 50 rounded figure. So what we can do here is, we can even extend the stop loss and set this at 1.5440 price level, which is the rounded number of 40. When the high or low of this swing point is at or near 50 or 100 rounded figure, price tends to extend a few extra pips, which is why extending the stop loss for another 10 or 20 pips is a good thing to do to avoid hitting the stop loss when your trade is right. Before you open your trade, you should calculate the stop loss size, and if you see that the stop loss becomes big, then lower your trade size or volume. This way, even your stop loss gets hit, you will not have to take bigger loss. Now let me show you a couple more examples of this stop loss setup, but this time for short sell entries. So let's say In this chart, we opened a short sell entry at the closing of this bearish candle at a lower high level in the downtrend market. Now, you shall notice that the highest price of the current swing high level is 142.42 and the nearest round figure above the swing high is at 142.50, so that means we can set our stop loss for this trade at 142.50 price level, or if you want, extend another 10 pips and set it at 142.60 to be even safer. So if we wait for a few more candles to form, we can see price went down without causing any damage to our trade and then created another lower high level where we can see a big bearish candle at the top of the swing high, which indicates to go for another short sell entry. So let's say we have opened another short sell order at the closing of this bearish candle. Now, to set out the stop loss for this trade, the highest price of the swing high is 141.92, which is only 8 pips below the 100 rounded figure. So we can set our stop loss for this trade at 142.00, or to make this trade even safer, extend another 10 pips and place the stop loss at 142.10. By extending the stop losses for extra 10 pips for these trades, we are allowing our trades to have more room to breathe in case price bounces back and retest the rounded price levels. Remember, our stop losses are there to protect the trades from unwanted sudden price movement against our trade direction. If you set your stop loss too tight, then there are chances that the stop loss will get triggered more often even if you are right about the trade entry and price moves at your initial trade direction after hitting your stop loss. So it is wiser to extend the stop loss a little further and finally winning the trades instead of narrowing down the stop loss size and drying out your account balance with more unwanted stop loss hit even your entry was good. So in summary, trade towards the direction of the trend, respect the market key structures, set your stop losses at a valid price rejection zone, give your stop losses some room to breathe by extending it further to the rounded numbers, and keep your trade size or volume in control so that you are never risking too much money in a single trade. If you practice and follow these rules correctly, then you will see more take profit hits than the stop loss and eventually you will make consistent profit from your trades. I will put the download link of all the graphics of this video and the indicator link in the description below so that you can study these strategies later and become more confident when setting your next effective stop loss. So this is all for today. Hope you liked the video. Let me know in the comment below of what stop loss strategy from above you are already using for your trades and having good result. And if you think this video helped you in any ways, then please consider giving a thumbs up to this video. And also, if you want to watch more videos like this from me in the future, then please subscribe to the channel. So that is all for today. We'll see you next. Till then, have a nice day and goodbye.